This is the current federal tax development for the week of October the 23rd, 2023. Current federal tax developments are brought to you by Kaplan Financial Education and by your state Society of CPAs. This week, we're going to look at the fact that PTIN renewals are now open for 2024. The IRS has announced a program to allow for withdrawal of ERC claims. And we'll talk about an actor's estate that loses in an attempt to claim he had validly rolled over a non-traditional investment held in his IRA. Let's start with the PTIN renewals. Now, this is from the IRS Tax Professional PTIN system dated October the 19th, 2023. Now, the IRS has opened the PTIN systems for renewals at this point. So, hey, that's probably good news. All tax preparers will need to either renew or obtain a PTIN before preparing returns for 2024. Obviously, if you're preparing returns in 23, you need to have a 23 one already. If you're just starting for some reason this late, you'll need to go get one, but that's something that should have already been discussed with you. The price to renew is down to $19.75. That's a decrease was previously announced related to the IRS loss in the tax court on this issue. And you'll need to again confirm you're aware of the requirements to maintain the security of your client's data. That's mainly so that you can't claim later if something goes wrong that, hey, I never knew. That's the last box you're going to check before you basically go to pay for your PTIN. Again, probably a good idea to put this together now because it's starting now. But just be aware we're now down that path. Now, the big news this week was the IRS announcements for a voluntary withdrawal program. This is entitled From the Employee Retention Credit. It is a fact sheet we'll look at, which is Help for Businesses Steps Withdrawing an Employee Retention Credit Claim, fact sheet FS 2023-24, issued on October 19th. On the same date, the IRS issued a news release, and they put up a page for the employers to use to walk through how they'd go through the program. Now, when they announced their temporary suspension of processing of new ERC claims in September of 2023, indicated two new programs would be announced in the fall. The first would be a program to voluntarily withdraw claims that had not yet been paid, or which had been paid, but the refund check had not yet been cashed or deposited, and that's this program, as well as a program for those who have been paid to voluntarily return those funds with maybe certain additional relief. That program has not yet been announced, so be aware of that. Now, to do this program, you have to meet four criteria. First, you must have made a claim on the adjusted employment tax return, Form 941X, 943X, 944X, or CT1X, not on the original 941. If you have an original one that hasn't been processed yet, there's some problems, but this isn't the program to withdraw it. You filed the adjusted return only to claim the ERC. You made no other adjustments on that amended return. If you did, this is not the program for you. Also, you want to withdraw the entire amount of your claim. If you just want to reduce it, this is not the program for you. And the IRS has either not paid your claim or they paid the claim, but your taxpayer has not cashed or deposited the refund check. Now, some that don't qualify, but they have some advice for, if you want to reduce the amount of your credit or make other changes to the return, the adjusted return, the ERC FAQ page has information for both of those cases. They updated that as of October 19th, specifically telling you how to handle those situations. Right? Now, if you otherwise you meet the four criteria, if you used a payroll service, they do tell you you have to contact the payroll service. The payroll service applied for it on your behalf. You have to contact them because they may very well have filed one large claim for everybody. And assuming they did that, they have to process the refund claim on them. You cannot file your claim if you went through that system, at least until you get the go-ahead from the payroll service. It's okay to do so. So if you went through Paychex, ADP, whatever, contact them to see what to do next if you want to withdraw. What if you've not received a refund or not notified an exam? This is the simplest approach for this. If you do that, you make a copy of the adjusted return that you sent in that has the claim you want to withdraw. So get a copy of that. In the left margin of the first page, write the word withdrawn. In the right margin of that page, you want to sign and date. Have an authorized person sign and date it and write their name and title next to their signature, right? Then you want to fax a copy of the return to the IRS ERC claim withdrawal fax line at the phone number 855-738-7609. This is the withdrawal request. You want to keep this with your tax records. They do have instructions for those who cannot fax a return. What they're going to tell you to do if you can't fax a return is they're going to want you to basically send it in mail, but have it traced. That'll be the key. They strongly prefer the fax. If you can make it work, make the fax work. Now, what if you've not received a refund, but you've notified you're under audit? You prepare the withdrawal request just as with the prior case, but don't fax or send it in. If you've been assigned an examiner, you should communicate with the examiner about how to fax or mail the withdrawal request directly to them. You're going to go through the examining agent. If your case has not yet been assigned an examiner, but you have an audit notice, you should respond to the audit notice with the withdrawal request using the instructions in the notice for responding. We're going to respond to it. We're going to basically use that and attach the request that we would have faxed in. Presumably, that'll then be handed on to whoever is going to be assigned to our case, and they will work through processing it, assuming it goes through. If you did receive a refund check, but you've not cashed or deposited it yet, you're going to mail the voided check with your withdrawal request. You're going to prepare that claim withdrawal request as in the prior two cases, but again, don't fax it this time. Only fax it if you've not yet received a check, right? In this case, go ahead and write void in the endorsement section on the back of the refund check. The clients cannot deposit the check in their bank account, then write a check to the IRS. That does not work. If they deposit the check, they are not eligible for this program. So they have to have not deposited. Mail the voided check with the withdrawal request. Prepare the claim, like we said, do that in line. Include a note that says ERC withdraw and briefly explain the reason for returning the refund check, and then make copies of everything. Front and back of the voided check, the explanation notes, the sign and dated withdrawal page, keep that in your records. I would tell every client, that's in process right now that might be considering this about, well, here's what we're going to have to do if you get a refund. If you get a check, don't cash it. And that's also going to be true if you've sent in the withdrawal request, the next day a check comes in. I would, again, not cash it, right? We'd start working something different. That's going to happen to somebody. Right, there it is. Now, I also say if you did get the check, don't staple, bend, or paperclip the voided check. Include it with a withdrawal request, mail it to the IRS at an address in Cincinnati, P.O. Box, Cincinnati Refund Inquiry Unit, P.O. Box 145500, mail stop 536G in Cincinnati. Make sure you track your package to confirm delivery, and I'd probably suggest using registered mail for this. It's just going to be the simplest approach. In essence, that gives the highest chance it doesn't get lost. There's a reason why you use registered mail for like stock certificates and the like. I'd consider paying for it in this case just to avoid the hassle problems. Okay? They will notify you if your withdrawal request has or hasn't been approved. If it's not approved, you want to figure out why it wasn't. If it's a simple fix, get it fixed. If, however, the IRS provides limited details, there has to be at least some concern about why that's true. And that has to be, are they considering a potential criminal referral? And again, that's most likely going to occur if they believe your clients invented employees, right? Or done something else that clearly you should have known was wrong. They didn't really pay any wages in the quarters in question. Could look bad if your client never actually filed the 941 to begin with. That'd be a bad move. Things like that. So obviously consider that because you could be your client's own worst enemy. If in fact there is a CID referral, if you continue to work with them, because anything you learn, you can be forced to testify. So, if it appears that there's, and hey, clients sometimes lie to you. So, and you don't want to find out about the lie. So again, if not, tell them you probably should go seek legal because there are very few reasons why they should reject. And if they're not the obvious ones, then yeah, we need to look at it. Somebody needs to look a little more detail. If you have received a refund, the IRS is working on guidance to be released this fall. Unfortunately, they've not said they're pausing issuing exam notices at this point. That means that if your client does believe they've received a refund, they shouldn't have received any. Is it going to be better to file and pay back now? Or is it going to be better to wait? Because in the interim, exam notice could appear. but the program can give them a break. Will they give that break back to those who filed earlier? I suspect they will, but it's something to discuss because the IRS may be suspicious if you got the exam notice and now you file. And that may turn into a problem. So I think it's time to have a clear discussion if we have that issue, right? What's going on? If you have an employer with a valid claim who's not yet filed, the statute limitation continues to run those claims. Remember, the 2020 claim statute runs for most taxpayers, runs out on April 15th of 24. So if you're a client, and why are they out there? Because, the ERC mill ads were so over the top that a lot of them just consider the whole program to be fraudulent. They don't want anything to do with it. But if they actually qualify, they should do it. If you can get in there, especially if they have a drop in revenue that you can document well, they really should do it. But you need to make sure it's clear. But you do need more than the word of a consultant getting paid a contingent fee. They qualify. Well, I'm sure there were some people that took contingent fees that were doing it all correctly and everything's right. We do know the IRS considers contingent fees to be a red flag. So it would be very useful to get a second opinion in this mix and probably, have that person be, to the extent you're involved, have that person ready for exam work rather than necessarily worrying too much about the consultant. Because again, we don't want to get into that. We would like to avoid that issue. So we'll see what's there. And certainly if you do a claim right now, I would try to make it very clear, as many details as I can. I know some people like to do skeletal claims, as little as is required. But in this case, I'm afraid that's going to just open you up immediately, make you far more likely to be examined, and the exam is going to be the exam is going to be nasty even if you prevail. So we prefer to avoid it until then. Now, the practical problem is the fee the consultants want. It's not likely they're going to agree the claims are invalid. So if you withdraw a $2 million claim, there's a 25% contingency fee. They may very well demand the client pay $500,000. If they won't back down from that and the claim's not valid, they probably need to get legal counsel involved to attempt to get the fee waived. I suspect that that's probably the only way it's going to happen is if they're convinced they might be hauled in court and they're going to have to justify what they did. A lot of them would prefer not to do that, I would assume. So if it's bad, go there, but be there. But as I say, don't assume you'll get it. Finally, we're going to talk about the estate of James Kahn versus Commissioners. This is a tax court published decision 161 TC number 6, issued on October the 18th. Okay? Now, per the opinion, this is a great statement in it. This case is a quintessential example of the pitfalls of holding non-traditional, non-public trade assets in IRA. Failure to follow the labyrinth of rules surrounding these assets can mean forfeiting their tax advantage status. And this case is reported, though, because the key issue to be decided here was whether the tax court has the authority to review an IRS decision not to grant an extension of a 60-day rollover. The court will hold that it does. But the bad news is for the taxpayer, they're told the IRS didn't abuse their discretion. But it is a little bit of good news in that if you filed for a 60-day rollover waiver, the IRS doesn't grant it. In theory, if you really thought you were right, you could put the money in, wait for the IRS to try to assess the tax, and then come back and go to court because you've got at least a ruling that they could review it. Now, in this case, James Caan, you may remember, actor, best known probably for his role in The Godfather back in the 70s. I think that was the 70s or was it 69? Anyway, it's back a ways. He had a financial team, though, that took care of his rather substantial investments. He had a very, very successful career over many decades, right? That includes his IRA. His IRA held a partnership interest in a non-publicly traded hedge fund, right? Now, there's a problem here because that's not going to report a fair value. And under the IRS rules, the rules and the law, regulation and law, the custodian must provide a value, a fair market value for that annually. And UBS was not going to be responsible for that. So they had an agreement with Mr. Caan. It was really with his advisors that a valuation must be provided annually. Okay, as we said, is required under the law. Now, the financial advisor in 2015 moved from UBS to Merrill Lynch. And he looked to move the IRAs there. And this is where things go off the rails, right? This is where the problems occurred. Now, Everything else in the IRA held assets that were publicly traded, easily transferred. Merrill Lynch accepted them. It's not stated openly, but it appears that Merrill Lynch absolutely would not hold that partnership. And I suspect it's partially because they want to be in the mess that UBS gets in here. So in any event, though, the partnership did not transfer. But the advisors didn't notice that the partnership did not transfer until late 2016. Because like the K1 came out and it still showed UBS, right? UBS as custodian of the IRA for Mr. Khan. So eventually, the guy that moved to Merrill Lynch said, well, shouldn't that have been retitled to Merrill? And of course, they went through the whole mess. And again, they couldn't get it retitled to Merrill. That was it. So eventually, they sold the partnership interest and deposited the money into the new Merrill Lynch IRA. As we'll discover, that will be a problem because putting it in the IRA turns out not to be the greatest thing in the world. Okay? Now, in the interim, UBS never received a value for the interest at the end of 2014. My guess is, this guy assumed it was going to Merrill. He may have had a bad relationship with UBS at the end. We don't know. But in any event, no value got provided. They tried to reach out to the partnership. It didn't give them a value. They then tried to reach out they sent letters to Mr. Khan and his advisors. In August, they said, we need this value. If we don't get it, we can't be your custodian. When they got no answer, they wrote again, demanding a value and indicating if they didn't receive it, the interest be treated as distributed as of a specific date in November of 2015. Again, no answer was received. So as of that date, they distributed it, right? It was out, right? So in November of 15, they sent a letter again to all the parties, noting that they had resigned. Mr. Khan was now the owner of the partnership and that he had 60 days to roll it over or it's going to be taxed as a distribution. Again, no one reacted to this letter. Now, it's tough to know why they claim they never got the letters. The court will not buy that story. So I'll phrase that right there. They found it implausible. More likely, everybody assumed somebody else took care of it, and nobody ever took care of it at all. Right? So what happens, except for UBS? The first reaction came when a 1099-R showed up. That's probably the surprise most people, that suddenly people started moving, right? UBS was asked to, but refused to revise a 1099-R. That's what the guy that moved to Merrill said, well, fix it. You guys shouldn't have distributed it, et cetera, et cetera. So on the tax return, the tax preparer reported it as rolled over. Of course, that's going to match any 5498s, right? Not going to work. So the IRS issued a CP 2000, right? And by the way, the rollover came out, finally got cash over after he sold the interest. He sold the interest after the November date when it was distributed to Mr. Khan, after they noticed this, so in 2016, and basically almost a year later when the money finally went in. So they sought a PLR for a late rollover. Okay. And as we said, that's it. Now, one real problem is IRA rollovers of non-cash assets are subject to a same asset rule. That's not true under things from a retirement plan to 402, but is under 408. The court points out that distinction. So they could not put the cash in the Merrill Lynch account if the partnership interest had been received as a distribution. And the court found that UBS had distributed it. Right? They also found that the IRS had not abused its discretion in denying a 60-day rollover relief, as the problem was not that the rollover was late. It just wouldn't have qualified anyway. Even if they were allowed a late rollover, this was an invalid rollover. As an invalid rollover, they really can't do anything with it. So that turned out to be a problem. That's probably a good line to say that you really should be looking and be very, very careful about these self-directed IRA rollover problems. I had cases on it before. This is not unusual. But this particular problem, I suspect what happened was that Mr. Khan, having a really big account, was able to get UBS to agree to go ahead and have his funds, hold this thing they don't normally hold. I doubt that your client with a, let's say, even $1 million IRA account would get this sort of treatment. Basically it's like, no, we're not going to do it. They'd be like Merrill Lynch, we're not doing it. Merrill clearly decided they're not doing it, right, for this account. But the problem was when the guy moved over, nobody really traced, even though those letters came out, again, seemed to be a division of responsibility. The guy that moved from UBS to Merrill just kind of assumed, but apparently never noticed it, never got there. How they missed this was open. The other reason why I didn't believe they never got letters was because after the rollover, UBS didn't send any more statements about the IRA account. If in fact they thought UBS held the partnership, somebody should have wondered why we weren't getting IRA statements, right? Nobody ever questioned that. That's why the court didn't buy it. These are very, very difficult to run. And the problem is, in this case, it appears that the guy running Point was probably the financial advisor who really isn't a tax expert. The individuals with who are doing his return and accounting, they probably just assumed that guy took care of it. And anyway, they're not really experts in this area. If you're going to have a self-directed IRA, as the court said, there are a labyrinth of issues and there are huge potential problems. You really need to make sure the client has somebody who is clearly responsible on the team for verifying this thing stays in line. And it probably won't be that company you hired as trustee, for a self-trusteed one in this case, right? I mean, in this case, UBS pretty much did everything they could. Just nobody paid attention to them. It's a problem. And this is a huge difficulty. So as I said, the one piece of good news is we do know now we can ask the courts to review if the IRS denies this, but doesn't really mean it's going to help us that much. So this has been, this week I tried to keep relatively short a tax update because I figured you're pretty much burned out from tax season. If you have any questions, email me, edzollers@currentfieldtaxdevelopments.com. If you want to, you can also follow me on the Connect sites for New Jersey, Arizona, right? Minnesota, Illinois, Washington. I watch those, and also discussion boards on Idaho. So keep your eyes there. Otherwise, we'll see. Next week will be a very interesting week with my travel schedule. So I'm going to be kind of in between going places on Saturday and then going places on Sunday. So we'll see when it gets recorded, but we'll try to get something together. Otherwise, hopefully if you have any questions, let me know. Otherwise, we will see you in the future with current federal tax development.